going to tell you about the US economy, and how we are positioning the fund too. We're basically expecting a strong and accelerating US economy, and there are four main pillars for that. First one, which we have been describing and very convinced about for the past almost 4 years now, is housing. Housing recovery is there, and I'll show you some slides. It's growing not very fast, but it's growing at an accelerating pace. The second point, and I'll cover all those points briefly, is energy. Of course, energy in the last few months has been a topic of great interest. The US shale, we believe, has been really bringing a huge, almost a revolution in the US, with a renaissance of manufacturing. And the price of oil, because the production is accelerating, we were expecting a decline of the price of oil. We were not expecting such a big decline. We thought it would stabilize between 80 and 90, and we still think eventually it will stabilize between 80 and $90. You all know, of course, that it's much below that now, so I will cover that a little bit. Other things that work well currently in America, in fact, America has all the stars aligned, if you want. After the crisis in 2008, 2009, public spending, and you've all heard about the sequester and the shutdown of the government and the deficit, but basically now the economy is in a much stronger footing, and the public spending has started to recover. Also, housing, in addition to housing, we have non-residential expenditure, which is increasing. I'll cover that too. And the state and local governments, will cover that, have started resuming salary increases and increases of their budget, because the tax income that they receive is much higher. So for several years, for 5 years, they were really negatively impacting the GDP. Now they're positively impacting GDP. And finally, one last point, which is probably even stronger today, and because of the low energy price, the consumers are in a much better shape in the US. Don't forget that consumers represent 72% of US GDP, so it's a very large part of the US economy. Jobs have improved. Unemployment rate is at 5.8%, which, you know, when we think of it in Europe, it's impressive. And they basically, the lower price of oil, just last week the Energy Department of the US said that with the price of oil in 2015, where it is now, even if it rises a bit, it's the equivalent of putting $750 in the pockets of every US consumer. So now I will focus a little more on housing. It remains very compelling. The housing activity should contribute by at least 0.3 to 0.4% of the GDP growth, and we've believed that because not for cyclical reasons, but because of demographics. Tu peux passer là. That's one of the most important charts for housing. The crisis that was the subprime crisis, we believe, was not the trigger of the financial crisis. It was a demographic reason. When you see the housing starts up to 2005 were at almost 2 million. And that was a time, because of the demographic of the US, where the children of the baby boomers were not yet in a position to start buying houses. In America, the first-time home buyers are typically 30 to 34 years old. And there was a baby, what we call a sort of baby bust. And that, we believe, is what started the housing crisis. It was exacerbated by the subprime crisis. And so it meant that the crisis lasted for a lot longer. But now the children of the baby boomers are becoming of an age where they start holding, wanting to buy, to form a household and to buy. The job situation has improved, and so they're starting to be in the market for either buying or renting houses on their own. And we believe that although currently there's only 1 million units started in 2014, that it would be necessary at least to build 1.5 million. So we think it's going to be sustainable for several years, because the children of the baby boomers will be at that level for several years. And we know it's demographic, so they're already born, they're in 30 to 34 years old, so it's not a hypothesis. Because of the crisis, they remained staying with their parents for much longer than normal. Typically, on average, between 1990 and 2007, 11.4% of that class age, 25 to 34, were still living at home with their parents. In the last few years, in 2013, you had almost 14% staying with their parents. They're getting older. They don't want to stay with their parents, and their parents don't want them to stay either. So basically, they're ready to move on their own. And what's encouraging is the mortgage growth in 2013. A lot of young people applied for mortgages. So that's housing. We believe that's very strong, and it's going to be sustainable for quite a while. And that really is an important part of the US economy. Now, oil, energy. I mentioned we were expecting a decline of the price of oil, because as you see on the black line, the production of oil in the US has been steadily increasing. And the spot price, well, that's somewhat of an old chart, because it was then around $80. As we all know, it's below 50 now. But that was accentuated by the decision of OPEC not to cut production, which they had always done since the early 70s, the first energy crisis. Some people or some media have said this is to try and prevent US shale production. We don't believe that's really the case. We believe it's more a geopolitical decision to try and convince or force Iran and Russia to cut production, not just have the Saudis themselves be the only ones to cut production. So we think it's very much a geopolitical issue. You probably all know that at that level, I mean, there are a number of countries that are very much hurt by that level of the price of oil. And it's not the US, it's not Europe, it's really Russia, it's Iran, it's Venezuela, it's deep offshore Brazil, it's the Arctic basins. So basically, at some point, and we don't know when it is, it's like foreign exchange. It usually overshoots. It goes too far in one direction, and then it goes back somewhat. We think the price of oil is going to be somewhat similar. We think it's currently overshooting, but it may continue to overshoot for a while. But eventually, because of it's really a question of supply and demand, at the level of $50 or less, there are a lot of production that's going to be cut. And again, the first ones will not be the US oil shale. And therefore, at some point, there will be a balance between supply and demand. It may be, hopefully, later this year, maybe into next year. We really don't know. Again, because it's not rational. It's geopolitical. In our view, it's geopolitical. But the side benefit is that all the countries that benefit from a lower oil, it's really a boost for consumption, it's a boost for manufacturing, and it has some positive sides for many countries. There on that chart you see that the US oil net imports have been plummeting for the last few years, and the production has sort of leveled, and if anything is increasing. On the left side you have the oil, and on the right side you have gas, natural gas. Now natural gas, the imports have almost completely disappeared, and again the natural gas, mostly from the shale, has been rising very, very fast. The main oil basins for US shale, and you see there, we show there a chart which shows the break-even prices for the main basins, and we've put on the vertical below those little bars some of the names that we own or have owned in this field, and for some of them, the ones that are to the right, are obviously not profitable at $50, but a lot of companies, and that's the price required for a 10% after-tax rate of return. A lot of them have prices that are below 50, and one has to focus on the ones that are well situated, that are not too much in debt, and that have very low break-even cost price. And they continue, and they constantly, because of the improved techniques, constantly lower their cost of production, and they also increase tremendously because of the improved techniques. When they used to be able to extract 2% of the proven reserves, maybe 2 or 3 years ago, with the improved techniques of fracking the oil and the gas, they are able now to extract 10, 15, in some cases even 20 or 25% of the proven reserves. So that's a huge, I mean, it's a multiple of what they used to be able to do. So the US shale production is going to continue and increase. Again, some of them will have to cut production, but basically overall it should continue and increase. So that's for oil and gas shale, and now the next reason is public spending. State and local governments in the US have to, contrary to the federal government, have to balance their budget every year. So since 2008, they had been tightening their belts. They had been firing policemen, firemen, teachers, freezing wages. Starting in 2014, for the first time in 5 years, income and their tax revenues, primarily from improved business, improved economy, and improved real estate, had been going up, and for the first time they had excess in surplus in their budgets. And in 2014 they started to hire again teachers, policemen, firemen, and to increase wages. And you see on average, from 1947 to 2007, the state and local, that's in the little chart below the graphs, the state and local contributed almost a little over a third of 1% to GDP growth. So GDP was up 3.41 on average. The federal government contributed 0.22, the state and local 0.34, and the private sector, GDP ex-government, 2.85. From the period from 2008 to 2013, the GDP was up 2.25%. The federal, we know, was cutting back, so it detracted 0.10%. The state and local also detracted because they had to tighten their belt, 0.23, and so the private sector was a little lower than in the previous 50 years, but not that much lower. It was still growing at 2.58%. This year, we expect that this year, and already it started last year, at the end of last year, the state and local contributed positively, and we think that's going to continue certainly in the next few years. And don't forget, state and municipal government workforce represent about 14% of total US non-farm payrolls. And their wages in most states, the minimum wages have increased, and in most states they have been increasing the wages. Private spending. We know residential housing has started growing slowly, but surely. What had been lagging is non-residential, commercial and industrial and institutional. Institutional is schools, hospitals, and so on. And we look at some figures reported by the architectural firms, which are early cycle players, the American Institute of Architects. And basically, you see that in 2014, non-residential total was up 4.4%. They had not grown at all before in the previous few years. In this year, in 2015, because they're already starting to work on projects, it's going to grow 8.1%, and they're all growing, including institutional. So we think that's going to add probably 0.25 to 0.30% to GDP growth. The consumer, that's also really the key, one of the key factors. The consumers benefit tremendously, and in the US there's a lot less taxes. I don't know how it is in Spain, but in France, the price of gasoline is mostly taxes and a little bit the price of oil. In America, it's mostly the price of oil and some taxes, but very minimal. And so when the price of oil goes down, it directly translates into a big advantage for the consumers. And I mentioned earlier that the average US household could save $750 this year just because of the lower price of energy. Since June of 2014, gasoline prices have come down 37% in the US on average. So it's a very big boost. Auto sales, conversely, because obviously people feel more comfortable, have increased 13% year over year. So basically, it's growing strongly. The strength of the dollar, that's one of the not everything is positive. The strength of the dollar, obviously, and it's probably more the weakness of other currencies like the euro and the yen. But anyway, the dollar is strong, and so that's going to be an impediment for multinational companies. But in terms of imports for the US, it's a benefit. It doesn't import that much, but whatever it imports, it will be cheaper for the US imports. However, their multinational companies will probably have already started to see their earnings being somewhat hampered by the strong dollar, and we think that's going to be even stronger effect in 2015. The market valuation, that's also another question that people have. The US market, it's I guess the 6th year now in a bull market. Is the bull too old? We believe that there is still, not everything is cheap, but not everything is also expensive. And so on average, you see that the price-earnings ratio of the S&P 500 is just over 16 times, which is pretty much very close to the average over the past 15 years. And it's above the last 5 years, but don't forget the last 5 years was primarily the crisis. So we think that although the US market has gone up a lot, we think that because of the very strong backdrop of economy and earnings for companies, and primarily domestic companies, we think that the market has room to grow further. And there is definitely a decoupling of what's happening in the US and in the rest of the world. The blue line you see is the earnings of US corporations, the trailing 12-month earnings, and just typically Europe has been pretty much correlated for many years, but since the last, I would say, couple of years, it really has decoupled. You see European companies' earnings going down, and which is the right-hand scale, and the US companies continuing to ascend. And we believe the earnings are going to continue and grow, and it's going to be an earnings-driven market. So we're assuming that the corporate earnings will continue to grow based on the strong US economy, the public sector employee income growth. We believe Europe at best is neutral. Hopefully, it we'll see. We have elections in Greece, we have Russian crisis, so there's a lot of uncertainty. We expect a very positive impact from low energy prices, and the PE levels probably will not expand as they have been doing in the last few years, but should probably stabilize, but probably not decline. Now, there are risks. I mentioned already a few. There is the geopolitical risk due to lower price of oil. There is the slowing growth in China, the risk of deflation in Europe, the risk of failure of Abenomics in Japan. We're worried about Japan and how it's maybe not be able to get out of deflation. When and if, when the Fed raises rate, maybe that's going to be, a scare for the market. So much liquidity has been pumped in the systems that at some point we believe inflation will come back, but we don't think that's anything immediate, because for the time being, I would say the pressure on prices is stronger than the rising liquidity. In the US, you also have Obamacare, the health insurance market, which is in a state of flux, and it's still one doesn't really know which way it's going to go. And then the risk is also, if the dollar becomes too strong, it may create more problems for the US, and you have the risk also that the US economy which is really, the world is running on one single engine today, which is really the US. And the risk is that the US is not strong enough to pull the rest of the world along, and that it's the rest of the world that sort of reins in a little bit the US. So the portfolio, we have a portfolio which is well positioned for growth. We have asset plays, we have industrials, some shale plays, although we were always underweight in energy, but we have the shale plays which have a much higher beta, and so the portfolio really suffered particularly in the last quarter, from the price of oil. And we have increasingly some consumer-related names. So I'm giving a few examples. On the asset plays, we have not the home builders, but the developers, companies like Howard Hughes and Alexander & Baldwin, who have huge portfolio of land that they are developing. And they're selling not on a PE basis, not on a cash flow basis. They're selling based on their asset, the value of the asset and the intrinsic value. Howard Hughes, we bought 3 years ago at $42. It's today at around $115, but the development of their assets in the last 3 years means that their intrinsic value has gone up tremendously, and so it's still selling at about 50% discount to its intrinsic value. Alexander & Baldwin is in Hawaii, similar, very, very, very rich in their assets and developments, and they're selling at a very, very large discount to their intrinsic value. Slide problem.
While you get your slides arranged, can I make a question?
Sure.
Do you have any chance a comparison of the PEs of the mid caps versus the large caps in the US? Is there a difference in the PE right now?
There is a difference more by industry. Some industries, and what happened last year was the very defensive, high-yielding companies were the ones who were really favored by the investors, because you couldn't, the bond investors could not find any, I mean, the yields on bonds were so low that they went to equities yielding high, and people, after the very cold winter, which everybody thought, okay, the US economy is stalling. The second quarter was much stronger, but people thought it's just a catch-up. And because rates, the long rates, went down in the US, and that was not because of US reasons, but because of the alternative between European and Japanese long rates and the US rates. Bond investors generally went to the US because it was safe and it was slightly higher rates than, which was totally counterintuitive. You would have thought that with the problems in Europe, the rates would have been higher than in the US. And so people then said, oh my God, probably the economy is not that strong. The bond market indicates to us that the US economy is not strong. We believe and now we know it's been vindicated by the numbers that it was not the case. It was just because of that the rate issue, which was not a US problem. So to go back to your PE, the very defensive, high-yielding companies became very expensive. Healthcare, for instance, the pharmaceuticals became very expensive. The mid-caps were suffered until the end of September. The mid-caps were really very weak, and that we have a lot of mid-caps in the portfolio that really weakened. I don't have the number, but I'll try and find it, and if you give me your card, I will be able to send it to you. But certainly there were many differences by sector. The telecoms, the utilities became quite expensive. On the other hand, a lot of the industrials were quite, very reasonably priced. So I think it's more by industry than by market cap. Industrials, there is accelerating growth in most end markets. United Technologies is a name that we introduced later in the year, last year. It's linked to both construction and aerospace markets. They're not that cheap. They're selling at 16.7 times earnings, but they have a double-digit growth. And we think they're interesting because of non-residential housing accelerating. They do elevators, Otis, everybody knows, the air conditioning carriers also, which is very big in commercial buildings. And Littelfuse, which is a leader in circuit protection, is a mid-cap, and it's growing very, very fast. So it's one of the stronger growth in the portfolio. Again, the P is not that cheap. It's done extremely well last year, but there's still upside potential. And SPX is another one. It's a specialized engineering solution for flows, and they're going to split their company. So those are some of the examples. In the shale, we actually have three names: Pioneer, Laredo, and WPX. When the prices, the stock prices declined, unbelievable. I mean, they plummeted in the fourth quarter, but it was done completely, we believe, indiscriminately, because those companies have hedged their 2015 production at prices much above today's prices. The prices are they've hedged them at around $80. And so if the price, they will not be hurt in 2015. If the price of oil stays much lower, in 2016 they only partially hedged. Laredo, I think, is hedged 50% for its 2016 production. Those small producers, unlike the big ones, want to sort of flatten out and not sell as high as they could, but make sure that they have the cash flow. So typically they will hedge their productions. One name that we used to own, because it's one of the better players in the shale industry, Whiting Petroleum, we sold at the end of the year because they, having probably one of the lowest cost of production of oil, below $30, had decided to unhedge. And as the price was going down, we said, okay, they have unhedged. will get out because we want to make sure that we think they will survive. We think they will be bought by somebody because they have fantastic reserves and they're very good player, but we erred on the cautious side. Pioneer is probably one of the best names. Consumers, UPS, it's e-commerce. E-commerce has really started picking up very much last year and continuing this year. And then the most recent addition to the portfolio is Thor Industries, which is a manufacturer of recreational vehicles, which is a typically US thing. It's those big, it's not really mobile homes, but it's like mobile vehicle that people drive around to go through America and also to go fishing and hunting and so on. It's basically benefits immensely from the lower price of oil and also from the demographics, because the baby boomers, when they retire, like to travel around America. That's their sort of dream. They sell their big house and they either buy a smaller apartment or they buy one of those. And there are only 3 players in the industry, one of which, the other 2 are private, one of which is owned by Berkshire Hathaway, by Warren Buffett. And so Thor Industries is definitely one of the beneficiaries of lower price of oil. So for the outlook, and I think I've been already too long, so I will stop there. We have about a third of the portfolio in the fund, which is directly or indirectly related to housing. We have about 6% in shale companies, so we are not that much, but with very high beta, and we think that when price of oil goes back up, they will greatly rebound. We have an industrial sector where the growth is driven by US growth primarily. We have probably close to 60% of the portfolio which is really linked to domestic. And again, I put energy in global because it's global. And we believe that cyclical stocks will catch up as the market realizes that US growth is for real.
I would like you to explain us a little bit about what kind of asset manager are you? Because I want to facilitate a little bit for the fund selector. Are you growth? Are you value? Are you big cap, mid cap? I know you don't like this, but try to define yourself, please.
Okay, basically, we look for growth. Okay, we are long-term driven. So we've always managed. I think both Muriel and Paco mentioned that the firm was started by my grandfather in 1931, and we've always managed the family money alongside our clients. We look for growth. But because we manage our own money, we don't like when it goes down. So we're very careful about valuations, and that's why, for instance, we were very underweight in healthcare last year, because we felt the valuations had become very expensive. We think that the population is aging everywhere around the world, and the emerging markets need better healthcare, but we don't want it at any price. That was a mistake because the prices went higher. So we're very value conscious. So the Americans would call us maybe GARP, growth at a reasonable price. Because we look for growth, we think it's easier for a medium-sized company to grow. It's not that we don't like some big names, big caps, we do have some, but we think that there are a lot of mid caps that are much more under the radar and not so well known. And again, last year that didn't help us at all, because people who went into the market wanted the really big caps, the very defensive ones. So we're all caps. We invest in big or small companies, not that small, because we want them to have growth, to generate free cash flow, to have earnings which are sustainable. So we look for things that are going to grow for a long time, but we do have a mid-cap bias. So.
Okay. Another question. Una azafata que le dé el micrófono, por favor.
This one?
I wanted to ask how much of what percentage of the fund is in the hands of the family or the employees?
No, the family. This is a European fund, and basically it's in the same strategy. But my family invests. I'm based in the US, so I cannot invest in a European fund, but it's in the same strategy. In fact, we also have a European strategy, so it's split between the European strategy and the US strategy. The firm is owned by me and my partners, and completely owned. And we have 4 partners who have 90%, but all the staff also has some investment in the company, but and some of them have in the fund. But it's primarily in the European fund, the Luxembourg or the French fund. It's really outside. It's outside clients. Because my funds are in exactly the same strategy, but in the US LLC.
The question is, of the 1 billion you manage,
how much of the billion?
How much belongs to the family?
At this point, it's less than 10%.
What do you think about the sustainability of the margins of the US companies? You know, all the talk about the high margins, how they mean revert, and if you look the valuations adjusting for the margins, they are higher than what we've seen in the graph.
That's true, but we think that the availability and the price of oil, because of the shale production, local production, means that a lot of companies are going to onshore. They had offshored a lot of their production because of energy and wages, which have not been increasing that much. They're starting to increase a little bit, but not that much. We think the margins are going to remain quite high. In fact, they could even expand further because of currently the price of oil. So we're not afraid. Some people have been expecting a compression of margins, saying, they cannot continue to go up and up and up. But we believe that the margins currently are very sustainable, and in fact, if anything, would probably go a little higher because of the price of oil. There is no wage inflation at all for the time being in manufacturing. And in fact, with technology, and that may be a sort of liaison for Benoit, with technology and productivity improvements, the cost of producing things has tremendously declined. And as you know, the US is really the berceau, the cradle of technology. So there's a lot happening in terms of, whether it's Uber versus taxis, you have, and I leave Benoit to talk about some of those examples. The pressure on prices means that the margins are higher.
So to start with technology, it's clearly one of the strengths of America. And really, we are really right now in the middle of something which is really extraordinary. And I'm really thinking about the words. We've got 5 forces which are applying right now at the same time, and they are multiplying, and they are combining each other. And I will go in depth about this. So the 5 forces are mobility. You all have a smartphone, I guess, or a tablet. You know what I'm talking about because you can feel it, you live it every day. So I don't have to explain. You have the cloud. The cloud is really about industrialization, mutualization of all these IT infrastructures and put it in a much more efficient way, centralized way. And this is really also very strong nexus for innovation. Uber, Beatrice was talking about, you can start a company if you have a good idea, a good marketing plan. You can start a company and you have all the power, computing power you need just with one click. So cloud is really one very important piece, and it's also reshaping totally the IT industry as we know. It used to be that all companies were buying everything themselves and building their own IT system. Now you're renting IT, you're using as a utility concept, utility computing. That's a huge shift. And a lot of companies, all tech, are not prepared to this. They scramble to try to adapt. The third one is social. Social is really, and especially generational effect. So a new way of communicating. So you all know Facebook. On the business side, you've got LinkedIn, you've got Twitter, you've got also a lot of new messaging platform, WhatsApp, Line, Snapchat, which are very soon going to the 1 billion threshold in terms of users. This is very, very powerful. People communicate on a daily uses, real-time basis. And this is a lot of eyeballs going and moving from all media, which were press, radio, TV, going to the online. And so big data is all about a new way to look at the data. It's a little like oil. I mean, data is oil in the sense that it has a lot of value. And traditionally, nobody was really looking at data. Now you've a lot of data coming from mobile, from internet, from a lot of devices, tomorrow from the Internet of Things. And all this data give you a lot of knowledge about who people are, what they want, what their intent are, and how you can better set them. So this is really important. New technology also, I don't want to go too much in detail about that. And the fifth one is Internet of Things. This is something which is sort of coming. It's still a little fuzzy, hard to know, but we will see more and more about it. So 5 forces combining each other. Just to give you a rough idea where we are right now. The big steps in the IT industry, the last one we had was a client server. Client server was about 92, and it gave birth to Microsoft, Intel, Cisco, Oracle. IBM at that time was nearly bankrupt because of the PC, for some of you who remember, and Apple was nearly bankrupt also. So Apple survived just because the next wave was coming, which was mobility. And a lot of companies disappeared. We don't talk about them anymore. Computer Associates, Digital, Compaq, I can name it, a lot. Nobody talks about it. As you know, Winston Churchill said that, you know, the history is always written by victors. And so then you had Internet PC, which was interesting, but not so much disruptive in a sense. It didn't change so much. It just made new entrants like Google. And now we are here. Smart is social, mobile, analytics, and cloud. And this is really soaring right now. So just to give you an idea, 4 companies, Apple, Amazon, Facebook, Google, are worth 1,100 billion euro. To give you a sort of a benchmark, that's about the market cap of the CAC 40 in Europe. So this is just to give you an idea of the value creation we're talking about. We're talking about something which is really real. And then there's the Internet of Things, which will come later. So that's where we are right now. So Internet of Things, it's still something which is still sort of in flux, still need to be really defined. A lot of objects, consumer objects, I don't know if you have Nest still active in Spain. You can see some advertising in France. This is smart thermostat. You see smart lamps, LED lamps, smart shoes, smart balance, smart watches, smart anything. Drones to deliver shipping. We're talking about UPS, and drones to automate factories. This is Amazon plant manufacturing. And this is Kiva Robots. Kiva is a company they bought a few years ago. And this is a consumer side. What is really interesting is also about the business-to-business side, B2B. And we see the economy going after putting sensors everywhere in pipelines, electric meters, cars, smart grids, fridges, anything, and just to give a better, much more efficient way to manage things. I think it's about 30%, 40%, it depends on which country you're talking about. Water is leaked, water is lost. That's a lot. You can detect now when there's a leak and not wait for all the water to come down and at a huge cost. So this is, in the term of B2B, very important. So to give you just a few examples, what we're talking about. Mobility, it's about the disruption. When we talk disruption, we are talking about a new ecosystem, new entrants, new business rules, new go-to-markets. And this is about mobility. Look at the old PC system and look at the mobility. What is really interesting is that basically in the new system, and we are talking about smartphones outselling PC by a factor of 5. 1.5 billion smartphones sold every year. And look at who is dominating here. ARM, Qualcomm, MediaTek on the chip side, TSMC for the foundry, Dialog for power chip, and then you've got Apple, Google, and Samsung, and a lot of Chinese companies, Xiaomi, and a lot of Lenovo and so on, which are really coming up very strongly. So totally different system. So, you know, the value creation is clearly on one side. Now, another example about the cloud. Salesforce.com is a company we've been talking about, Paco knows that, for some time now. It's been listed in 2004. It's really business application. Think about SAP, but on the cloud. And it started really as a CRM focus, customer relationship management, taking care of your customers. And it's, if you take the IPO price and you look at the last price at the end of last year, it was a 22 bagger. So the stock price rose by 22x. So not bad, right? And what is interesting is that on this story, and I'm talking stock-wise here, is that you can see that at start, there's no way that if you want to catch this kind of story, and it was for us kind of obvious that this company was going to be big, there's no way that you can catch it looking at the PE. So you have to make a choice. Either you want really PE basis strategy, investment strategy, or you want to get into these kind of companies, but don't look at the PE then. So price to sale is much more pertinent for this kind of story. And what is interesting is that over time, you get more and more to a PE valuation. So now you can have a DCF on Salesforce, you can have a kind of a PE, or at least a DCF. PE is harder. And if you compare a mature company like Oracle with Salesforce, you can see that the two converge over time. So different kind of valuation, and also different kind of way to manage the holding. On a 10-year basis, it was 9 times the stock was down more than 20%. So this is clearly more beta, more drawdowns, but at the same time there's a lot of value creation. Don't look at the short term, look at the long term. Another example, social. Social is about new companies. I was talking about Facebook. Facebook is 1.35 billion users active. And so it's value creation also. But on the other side, it's also very important for corporation. I mean, if you have customers, consumers, they are all the time on these networks. If you don't go to the consumers, if you don't communicate with them the way they want to communicate, you're dead. And this is something which is sometimes a very hard lesson to learn. And this is Nestle's story with KitKat. There was a story about KitKat a few years ago. About the fact that they were using palm oil, and there was a lot of controversy, and they handled it very, very badly. And it, you know, it's just has the opposite effect. It's like when you have a fire, you know, you blow air on the fire, just, you know, gets bigger. So sometimes they had to backtrack completely and amend themselves and say, okay, we were wrong, we amend, and here is what we're going to do. And after that, the board said never again. And now they have 30 people in their 30s in headquarters in Switzerland, and they spend all the time monitoring, like a war room, and this is a war room, they call it, monitoring all the time. Everything is said, real time, on all social networks, on all the brand of Nestle, and reacting. So this is a game now you have to play if you're a company. So social is not just, you know, teenagers playing around and showing photo. It's real business. Another one, big data. I was saying about B2B. And big data is about changing the way you really work. I mean, it used to be that you had a plane, and the plane would go into maintenance every once in a while, you know, predefined. It doesn't make sense because each plane is different. And so it's much better if you monitor everything all the time in real time about the plane. It's a huge amount of data, terabyte of data for each flight. Then you take this data and you analyze it, and then you get to a customized maintenance program for each plane. If you gain 1-2 weeks of maintenance, right, you can postpone it. That's millions of dollars you gain. So this is a company, I mean, Accenture and GE, which are not small companies, they make a company just on this assumption that there was a lot of money, they could serve airlines company and create a new business. So this is really, I think, a good example of what big data means. Big data means big business. So another one, and so now we talked about making things different in IT, so it's kind of disruption within the IT industry. What is really interesting is that technology is more and more disrupting a traditional industry. And this is here about the taxi. Taxi is local, right? Each city has its own taxi. It's been run the same way for years, never changed. Now come a company. In a few years, this company is present in 243 cities, 53 countries. So it's a global company, and it's doing about $600 million revenues. This is amazing. And this is powered by what? By the cloud, everything in the cloud. And this is powered by mobile, because Uber is only available on a smartphone. You can't find it on a PC. So this is, I think, the era of the new era where you have applications which are only available on mobile, not on PC anymore. So it's really mobile first, or sometimes mobile only, a new paradigm. So not only Uber, a lot of companies, I can tell you, a lot of startups are really young kids. They're all trying to get to disrupt anything. So they won't all succeed. It will be very like Darwinian. But some are doing very well. I went recently to a presentation organized by Microsoft, and there was Accor presenting. Accor is one, I think it's number 3, worldwide accommodation company, hotels all over the place with a lot of brands. And Accor gave a good read on internet. They said first it was about people getting prices, better prices. Then it was about reservation, Booking.com, Expedia, and now it's about clear disruption with Airbnb. Airbnb is really eating our business, and we have to react. So they hired a VP of digital business, and they have to reinvent themselves, and they know it. So future will tell. But so there's no company, even banking, finance, Lending Club was IPO recently. It's about peer-to-peer financing. So there's no industry which is really protected right now. So this is very powerful, because if you take as an investor, on the standpoint of an investor, and you look at the opportunity, not the threat, the opportunity, it's great. So it's really a big change. I mean, we were talking for years about productivity, IT, talking to IT people, back office, SAP kind of stuff, Microsoft kind of stuff, footprint was on-premise. PC was the only device. 96% of devices were PC for 25 years. And business productivity was what we were used to measure. Now, by the way, business productivity doesn't seem to increase a lot, but who cares? I mean, it's not, the value creation is not so much here anymore. It's about leveraging SMAC, social, mobile, analytics, cloud, Internet of Things, and to create new businesses like Uber, like Airbnb, like BlaBlaCar, and so on and so on. So monetization used to be IT budget, corporate IT budget, or consumer electronics. It's still here, but it's more and more like a PayPal taking a share, of the payment. IT as a commission, sales agent. If you help companies like Expedia or Booking.com, they get a commission from hotels or from restaurants. And so on and so on. So advertising is about $600 billion spent annually by corporation. If you own consumers, if consumers come to you, if you're Google, if you're Facebook, I mean, guess what? I mean, you're going to take the money from TV, from radio, from press. So this is really the way we should look really at it. And there's an outcome which is really a new era of innovation. Sometimes we have to be honest, it's creative destruction. So you destroy and you create. So we invest in the creators, but it can be tough. I used to shop on Champs-Élysées. There was a Virgin. I don't know if you've ever been there, a huge Virgin shop. There was everything you want. Now it's gone. So what it means from an investor standpoint is that you can make a lot of money in technology. You have this opportunity which is pretty unique in terms of value creation. And this is, well, you had that in the 90s with the companies I was mentioning, but now you have to look forward. And this is about Apple, you know, the story, ARM, Google, Amazon, Facebook, and Salesforce, and so on and so on. If you look at the sales increase, it's about 9 times for Apple, 19 times for ARM. ARM is a UK-based company, it's IP, and ARM is dominant in everything which is mobile. You've got ARM. You use it every day without knowing it. And Google, Amazon, Salesforce, you can see the increase in terms of sales and the increase in terms of stock price. And what you can see is that basically it sort of follows the sales. So I was talking about the price to sell for this kind of company makes a lot of sense. And you can see also that the valuation, the premium multiple decreases over time, which is healthy and makes sense. So the goal is just to be sure you're going to invest in such companies. So you have to be very, very selective, work a lot, try to avoid all pitfalls, and make these companies, you know the valuation is going to decrease over time to come to a mature status like I was showing with Salesforce.com. And I have one quote which I like a lot. It's saying, talent hits a target no one can hit, and genius hits a target no one else can see. You know, when Steve Jobs created the iPhone, you know, nobody would ever think that this would exist. So this is about what's the highest value creation in IT is here, when you really create something that nobody thought of, and suddenly, you know, you make a huge new market. So it means that we've got a lot of growth stories we can find, and you can show it, and we can show it in the portfolio on equally weighted. It's about 27% top line growth last year, accelerating versus last year, previous year, and EPS is about 59% equally weighted. And if you compare it to the MSCI IT, of course the MSCI IT is very mature. It's growing a little more than the S&P 500, but not so much. So we don't put all companies like this in the portfolio. So I'm not saying that we have only Salesforce, Google kind of companies or LinkedIn. We try to balance the portfolio with this kind of high flyers, but we all retain this kind of investment themes, but we sort of balance the portfolio in terms of risk and reward by very strong growth companies. This is here, the company I was talking a lot about, but you have also a lot of companies here and here. Like in the top 10, you've got Akamai or Nice System, or we had Accenture, we sold it, but it could apply here. Cognizant, this kind of company in the 10-25%. So this is really kind of the alpha generation. This is kind of a sweet spot, kind of, and this is about 40%, 30%, and 20%. It can vary over time. So this is really the way we construct the portfolio. We can value all companies on DCF on the first two, and here we really look at price to sales. Here you have to be very, very, very selective. So to do that, you need to understand really what's going on. We spend a lot of time analyzing what's going on, the value chain, the food chain, the business models, and so on and so on. And we apply, you know, very traditional stories. It's just that we know this industry by heart. We've been doing this for years, but then it's all about barrier to entry, monetization, management, very traditional. So I will pass quickly on this. And so in terms of performance, last year, until 2013, it was kind of exceptional, beating everything. And last year was less good, so I just spent a little time on it. So we did reasonably well on absolute basis. The index did much better, so why? Well, as you can understand, the fund is kind of growth-oriented, trying to balance, you know, high growth, mid growth, and reasonable growth. At the same time, it's kind of a bias, mid-cap bias. And as you know, mid-cap was really the place not to be last year in relative terms. So we have a few mega caps, Google, Facebook, but not as much as the index, obviously. And we are growth-oriented. So as you know, tech is really kind of two techs. There is the old tech, Microsoft, Intel, Cisco, Oracle, IBM, and there is a new tech, Google, Facebook, Salesforce.com, and the two are mixed in an index, which is pretty much biased towards the old tech. Old tech is mega caps, defensive or viewed as defensive by the market, and pretty good yield and buybacks. If you add up yield and buybacks and you look at the top 5 companies making really the performance last year, which was Apple, Cisco, Intel, Microsoft, I'm forgetting one, you have basically add up HP, thank you, basically 3 times in terms of yield as the S&P 500, 3 times. So last year was a yield market, was a bond market, and everybody was looking for this, and so they went to tech. So don't think that tech as the index is about capex, is about early cyclical, no more. It's about defensive. And there's the new tech, which is sort of rising, but it's still a small part of the index. So when you buy the index, you get, what, 3/4 of the old tech and 1/4 of the new tech. If you buy your fund, you get 100% of the new tech. So this is about performance contribution. You can see some companies like I was talking in the mid, you remember the mid-range, in terms of growth, Akamai, F5. Dialog is more kind of high growth. This is a German, UK company. Apple, you know it, Facebook, and this is on the world. You've got also kind of high growth companies, but not only high growth company, but a lot of high growth company on the world side. So as I was saying last year, what happened? Well, pretty much the 5 companies I was talking about, you can look at the performance and you can look at the weight. And so this is about 63%, explaining 63% of the MSCI IT performance. And also the S&P 500 IT outperformed by a huge factor of the S&P 500. We think it's kind of really abnormal. But it happened. At the same time, it's an opportunity because it means that the fund, I showed you that we had 27% growth in dollars. The fund was basically flat last year, 27% growth, 59% EPS growth. This is a huge compression multiple because we didn't change the fund. We don't want to change it. So huge multiple compression. And just to give you a number, it's pretty hard to talk about the P of the fund because we've got this high flyer part of the fund. But even if we take this into account and included in it, we've got a P of 18.7 forward, and a PEG, which is about 0.9. So the PEG of the fund right now is 38% lower than the S&P 500. So we think we got to a point where valuation are really, really attractive for the fund. So this is about the market cap. As I said, we have clearly a bias, a mid-cap bias, not because we want mid-cap, but we want stories. If you want to look at Salesforce and you want to take Salesforce at the beginning, where it is really creating the most value, you have to go to mid-caps. If you wait, and you wait for it to be a mega-caps, well, you lose a lot of the opportunity of the upside. So that's what I said about valuation. And so I already gone to this. So in summary, I'm a little over time. We've got privilege of having very structural growth. So we don't care so much about GDP, global GDP is going to be 3, 3.3, 2.7. I mean, the driver is not here. There's no scenario or macro real scenario. It's all about this disruption, creating this value, and the main engine for investment performance. Valuation, as I said, is really, really attractive. I mean, it's been for some time now. And also, obviously, I mean, the fund is going to outperform if this imbalance in markets we had last year, especially in the US, is going to balance itself. Am I going to predict when it's going to happen? No. But I do think this is poised to happen, just because of the valuation opportunities that I showed you, and I do believe that the markets are efficient. So they are never efficient short term, but they always correct themselves. You never know why, you never know when, and afterwards it's very easy to explain, of course. But we strongly believe this is going to happen this year.
Hi, hello. 2 questions, if I may. The first one is, there's been recently quite a lot of noise about artificial intelligence, and I wanted to know your views about that, in terms more on the a disruption and business side, not more about the more human being impact. And the second one is people is spending lately a lot of time more on applications rather than on the open web internet, and data is the data is stored in those applications is closed and not at the moment accessible to the likes of Google and the search engines. So again, what's your view on that, and if you see the applications as a real threat to the likes of Google and the search engines?
Yeah, so to take the second question first, application, you're right. I mean, I think they're already sort of the entry point to the internet right now, so the gateway. And so you have to look at who is controlling this application. I'm not talking about games. Well, we could talk about games, but we don't invest here because it's very, changing. You have a game which is popular 1 year after it's another one, so we don't touch it. And if you exclude games, it's mostly about Facebook, LinkedIn, Twitter, Gmail, Maps, Google Maps, and so on. So basically, if you look at usage, 40% of total usage on mobile is Google and Facebook. So they really dominate the space. And you can add also messaging, which is really rising, I was talking about. So this is favoring WhatsApp is Facebook. It's been acquired, as you know, for a pretty hefty price. Snapchat is independent. And so that's really about Google and Facebook dominating the space. And Google has one advantage is that it owns Android. So it can, sort of add up stuff and so on. But Facebook has managed also to get a pretty good footprint. And it's really, really hard to get into it now. Look at Microsoft. I mean, they spent billions of dollars. Intel spent billions of dollars. They can't get in. So this is about barrier to entry, and this is about network effects. This is about huge ecosystems. We know that. This made the fortune of Microsoft for the PC era. Now it's making the fortune of Google and Facebook, and Google, remember, has Android. Android is 85% of the market. So usually in the financial community you see a lot of iPhones, but may I say that financial community is maybe not representative of the total world, and the fact is actually in Spain I think Android is pretty much present, in Latin America a lot also. So this is 85% of the market which is controlled by Google. That's a huge asset, and it's making a lot of money because apps, as you said, it's a huge business. Apple recently released it was making $50 billion totally accumulated on just commission they get when someone is selling an app, because they get a cut for everything. So this is for the second part, and the first part about artificial intelligence. This was talked a lot. Actually, I went to the US in the 80s, but it's big time, and then it fell into oblivion. Now it's really coming back very strongly. I think for a lot of reasons. First, there's a lot of computing power, especially available on the cloud, very cheap, on a variable basis. So you use it, you pay, you don't use it anymore, you don't pay anymore. So very efficient. Algorithm, I think, have made a lot of progresses, and especially something which is called deep learning. And actually Google, the leader here are really Google, Microsoft, IBM. IBM with Watson, we'll see what they do with it. But it's true that I think what we've seen so far is like search. I mean, Google says, and I think they mean it, that search is really very rudimentary right now. I mean, search should be much more intelligent. They should understand what I'm saying, what I'm looking for, without having me, to look at screen and clicking and spending a lot of time. So search is obviously something which is, I think, going to be much smarter. So yes, artificial intelligence is coming. You look at drones. A few years ago, everybody would say that the real test for artificial intelligence was whether we could drive a car without a man, just a driverless car. Right now, driverless cars are become a reality. So regulation is not ready yet, but in a few years you could really have driverless cars, and this could change a lot of things also. So yeah, I mean, artificial intelligence is really coming, and it opens up a lot of debate, philosophical, sociological also.
You quería hacer una pregunta. I wanted to ask you about the geographic orientation, because I see most of the companies you're speaking about are in the US. Why is that? There is no really disruptive technology in anywhere else? The first thing. And the second, you spoke about value creation that is very fast and so on. How do you catch? How do you take? How do you get this value creation in your portfolio, in your stock selection process?
Yeah, well, geography, I mean, we are based in France, so we don't have any, we try not to have any bias, but the truth is that a lot of things are done by American corporations. So we go where, where the best companies are. If we can find good companies in Europe, we do, like Dialogue I was talking about, ARM, or Ubisoft also in the gaming space, we have. And we go also to Asia, like the foundry business. TSMC is a huge dominant player. It's more than 50% market share, huge profitability. And we look a lot at the food chain also, what I should say, more than geography. I mean, what is really matters is in the food chain, who dominates, who makes the rules, and who makes the money. You remember the PC, I mean, there was two people making money, Intel and Microsoft, that's it. So that's what we do, trying to understand who makes the money. And changing over time, like the mobility, we had Apple and Samsung, we sold Samsung, we sold part of Apple. We think over time the device is going to be more and more a commodity, and so we want to move to services like we were talking about. So this is how we go into geography. So. And you were talking about value creation. I mean, again, value creation means that there's first a structural trend, very powerful, a real trend. I'm not talking about false trend, because brokers, media, and investor relations want you to believe that everything is disruptive, which is not true. There's a lot of false disruptions. You have to get at the real one. You have to get again at how the food chain is working, what the business model are. And also we look a lot at management. This is really important. I mean, when you are at the head of a company like Facebook and you go public, and just after being public, you have to adapt yourself and reinvent yourself totally, because you were a PC company and you have to become a mobile company. You need a very, very strong management, because you are growing at 50% at the same time. Think about it. I mean, if you run a company growing at 50%, it's a huge challenge. At the same time, you need to adapt yourself all the time, because things are changing all the time. So you need various management. Management for us is certainly by far the first metric we look at.
Another question there. Micrófono, por favor.
The USA has many of those big social companies, and I was wondering, you got a little slot there for China, and China has another very, very populated market with a very, very different language. And I was wondering whether you think China will play a major role in this tremendous change in the world, and whether whether you are investigating it, and whether there are very good opportunities there we should be looking at.
Yeah, China is a huge opportunity for tech. I mean, especially on internet and e-commerce. You know about Alibaba. Alibaba is already, I think it will be the fifth S&P 500 market cap. And China actually has much less physical stores. They went directly to the B2B kind of eBay kind of marketplace. China is very strong in mobile. Handset makers are starting, to invade by the bottom. And to some extent, I think China is probably the most advanced country in mobile and e-commerce. And these companies are going to go to conquer the world. If Alibaba went public, it's really because Alibaba wants to get global. And some say they maybe acquired eBay to get after Amazon. But it's really to be over time a game between US and China, and Europe will, I'm afraid, count the points. And so yeah, we have been looking at China for a long time. At the same time, we are careful. I mean, this is all corporate governance is not really a Chinese name. So yeah, we try to find a balance, but there's no way we can avoid China. Like Russia, we never went to Russia for the same reason, but it's really everything is rigged in Russia. And China, well, China needs, I think, foreign capital, and they want really to become a global player. So they have to play and to abide by global rules. So it sort of gives you some balance. So we wish we could have more in China, but at the same time we don't want to compromise with our rules. And so yes, China is just the beginning, I think. And by the way, on internet, I mean, China has managed something that Europe has not, which is dominating totally. Internet in China, which is the biggest market right now, is totally dominated by Chinese company. There is no US company and no European company.
Thank you very much to all you three. Has been very interesting. I think this is a very good opportunity to think in these two topics, the US economy and how to invest via this stock selection process and also in the technology. As our clients sometimes are saying, this is not the year for the index. We should be very careful selecting the stocks that will represent really the return in our portfolios. Then we offer you this opportunity with this asset manager that is clearly targeting growth in the two markets, US and technology, and through this selection process. Okay, thank you very much to all of you.